All right, what's going on, everybody? Welcome back to the MIE Trading Podcast, the podcast where I share my knowledge and experience on day trading, trading psychology, risk management, and everything else that you need to know to become a better trader. Today, I'm going to be talking about the 6 most important tips that you need to survive a bear market. And these are particularly important right now as I film this video because we are currently in a bear market. So before we get into the content of the video, very quickly, please remember to hit that subscribe button and click on the little bell so you get notified on the latest ways to improve your trading. Now, let's go ahead and get into the first of the 6 tips, how to survive in a bear market, and that is do not panic. Panicking is probably the single worst thing you can do in a bear market, and it's because panic is a very powerful negative emotion. And when we feel these very powerful negative emotions in our trading, it's more likely to cloud our judgment. And when we're trading with a clouded judgment, we're going to be thinking less rationally, making worse decisions, and those worse decisions are going to show up as worse trades. Worse trades means less profit, it means more losses, lower win rate, all of the bad stuff that you don't want, especially when we're in a market as critical as the one that we're in now. And of course, those bad decisions, those bad trades, that's going to lead to hurt because you see your account size dwindling. And then that's going to lead to more emotion, more panic, which leads to worse trades, more losses, more panic, more losses, more panic, more losses. So the most important thing you can do is stop that train before you get on it. Just don't panic at all. Try to stay calm. So how can you stay calm? Well, number 1, realize that everyone else is in the same boat. Every other person is in the same market that you're in. Everyone else is seeing their value of their accounts go down and they're all panicking too. And so we know that pretty much every other trader out there fails. We know that over a long term, 97% fail. And in the short term, the number's a bit smaller, but nonetheless, pretty much everyone fails. So if everyone else is failing and you don't want to be like the everyone else that fails, what do? You do the opposite of them. They're panicking, you stay calm. You need to realize that a bear market is normal. It's a normal part of trading. We're always going to encounter bear markets. We're in one right now. We've had plenty in the past, and we're going to have plenty in the future. What separates you from everyone else is how you deal with it, especially how you deal with it mentally. So, number 2, the second tip for surviving a bear market is remember to calculate your risk. It sounds so simple, but most people don't do it. Most people want to focus on strategies. They want to focus on where they can buy, where they can sell. They want to focus on market timing. And they always ignore the most fundamental thing, which is calculating and managing your risk. Bear markets are the time where most people should be focusing on preserving their capital. Bear markets is where pretty much everyone else is losing 40, 50, 60% or more of their assets. If your parents have money in their superannuation, they're probably losing money right now. Nearly every single day, probably every single week. Everyone's losing money. So if you can keep your money and not lose, you're doing better than pretty much everyone else out there already. So when we're in a bear market, try to focus on protecting your capital, calculating your risk and managing it, instead of trying to focus on how you can make 1,000% return off the bear market, because for most people, that's just not possible. So how do you want to calculate your risk? What you want to do is you need to know what you're up against. So you need to look at the market. Look at the stocks that you currently own, or the oil stocks, what are they called? Commodities, real estate, whatever asset you own. Look at the current value of that asset. What price did you buy it at? Let's say that you currently have $15,000 in your trading account, and that's what you own. So from this point, you want to think, okay, what's the stuff going to be worth in 6 months from now when the market drops 50%? Assume it's going to drop 50%. If it's currently worth $15,000, that's a $7,500 drop. Now ask yourself, can I handle that $7,500 drop? Not simply can I afford it, because it's 50%, right? Of course you can afford it, theoretically, but can you handle that? Because in my experience, working with people, most people start to panic and have negative emotions at 10% loss. So can you handle 50? And you need to say, okay, I don't think I can handle 50%. And if you can't handle that 50% drop, which is 7,500 in this example, you need to reduce your position size, sell some of those assets. So now the 50% drop only becomes $2,000 loss. Can you handle 2,000? Sure. Okay. If you're at a point where you can handle it, then you can say, all right, I'm good to go. I'll weather this storm. When the storm stops, sun will be shining and I'll be good to go making money again. And if you want to be particularly conservative, you can say, what if the value of my assets goes down 80%? Because that's not actually that uncommon. Already in this market, we've seen plenty of companies drop over 80% of their value. And in the past, we've seen stock indexes like the S&P 500 drop well over 80%. It's a real possibility. And you do have to consider what would happen to your financial position if that happens. You can't just ignore that as a possibility. Ignorance will drain your account quicker than most other things in this market. Okay, so one thing you might say about this is, okay, well, what if I reduce my position size? Yeah, I'm gonna avoid a few losses, but what about if the market turns around? Aren't I gonna be missing out on profit? Yeah, sure, you are gonna miss out on a little bit of profit. But number one, as I said, this is the time to protect yourself, not try to be some hero and make a ton of money. Okay, now you might be saying, okay, well, what if I sell some of my assets? Now you might be saying, okay, so I sell some of my assets, I reduce my risk, now I'm gonna avoid losses, but doesn't that mean that if the market turns around, I'm not gonna make as much money? Yeah, it does mean that. But the thing is that, what would you rather? Would you rather lose so much that you can't emotionally bear it, and then you make dumb revenge trades, then you wipe out your entire account? Or would you rather reduce your risk while still leaving some money on the table if the market turns around? When the market turns around and you have confirmation that we're coming out of that bear market or the recession, then you can increase your position size. You can always increase your position size later if things are going well. You can't reduce your position size in hindsight after you've had a loss. And sometimes it's even harder to reduce position size after a loss, because reducing position size after a loss means it's going to take longer to win that back. It's best to start low, scale in when things go well, rather than start big, get hurt, reduce risk, take longer to make the money back. And also, think about all of the other people that are getting wiped out because of that exact mindset. They're like, no, I'm going to keep my money in because if it turns around, I'm going to make so much money off of this. And then they blow up their entire account because they hadn't calculated their risk. They didn't know that they could afford it. And so they lost when they could have just reduced their position size and weathered the storm, like I said, and then make hay when the sun decides to shine. And one more thing, if it's any consolation, because for example, if you got to reduce your position size to reduce your risk and reduce the amount that you can lose, that might mean closing positions that are currently in a loss. For example, you have a position open, it's currently down $1,000, and you don't want to close and take that loss. That is hard to do. It sucks to click the little cross to close a big losing position like that. So if it's any consolation, number one, what would you prefer? Would you prefer to lose $1,000 now, or would you prefer to lose $5,000 later because you couldn't close the position at $1,000? And I bet in the future you would be saying, if only I had closed at 1,000. The other thing is, I do it. Last week, I closed $3,000 in open losses to protect myself from future losses. It doesn't feel good closing those losses. That feels better than losing 10 grand, 15, 20 later on. So, if I'm doing it, maybe that makes it easier for you to do too. Okay, tip number 3, create a plan and write it down. Write it down is important. So, now that you're calm and you've calculated your risk in the market, now we can make a plan for managing your money so that you can survive and maybe even thrive in the market. So you make your plan. Are you going to close your positions during your relief rallies to get in at a slightly better price? Are you going to open shorts when the market shoots up to get in again at a better price, make some money on the way down? Are you going to hedge? Whatever it is you decide to do, what you want to do is make the plan, as I said, and write it down. Write it down with a pen on a piece of paper. But don't just write down, okay, short 3 units at 1,500 price, short 6 units at 1,000 price, and scale in as you go down. Sure, you do want to write down what you're going to do. But more importantly, you want to write down why you've decided to do that. So write down, short 3 units at $1,500 price because this is where I see a significant resistance level. This is where price played out before. The RSI says this. In my analysis of previous bear markets, these are kind of the percentages that we look at. You want to write down all of your reasons for making that decision. Now, the reason for that is because in the future, especially in a bear market, we're going to see your price the price is going to drop. The value of your account might drop. Again, you might get into that position where you want to panic. You're going to be feeling heightened emotions, and you're going to need someone who's grounded in reality, who is thinking rationally to point you in the right direction. And no one can do that but you. So when you write down your reasons why, in the future, when you're feeling emotional and the market's volatile, you can read your previous thing that you wrote down. Okay, so this was my plan and this is why. The RSI and the support, and you look at it now, okay, yeah, that does align specifically with my plan, and I'm feeling emotional for no reason. So now I can be reassured that my plan was good and that I should stick to it, even though I'm feeling emotional right now. And as we know, if that helps you stay calm, that helps you stay rational, you're going to make better decisions. You're going to be able to profit from the bear market instead of losing half or all of your money like everyone else. Tip number 4 to avoid losing money in a bear market is to diversify your portfolio and reduce your risk. So here's a couple little information bits. Growth stocks tend to drop harder and faster than value stocks in a bear market. The other thing is that consumer staples tend to outperform other sectors that are more luxurious, non-essential, nice to haves. Let's say, for example, you're currently all in on growth stocks because they performed exceptionally well over the last 2 years. You're going to see them perform exceptionally poorly during this bear market. So perhaps reallocating some of your capital to value stocks or to the consumer staples sector, that might reduce some of the losses that you take. So instead of taking a 65% loss during this bear market, perhaps you could take 30%. It's still a big loss, but it's half of what you would have had otherwise. And of course, this is a big oversimplification of it, but the point is that diversifying your portfolio may be able to reduce your losses. Because let's say that if you have all your money in one basket and that one basket loses 80% of its value, you lose 80% of your money. If you have money in 2 baskets and then basket 1 loses 80%, basket 2 loses 40%, if you're equally exposed, now you lose 60% instead of 80 before. If you have your money in 5 baskets, this one loses 80, this one loses 40, this one loses 20, this one stays the same, and this one makes 20. Now, instead of losing 80%, you might be able to, that's some quick maths that I can't do, it's around about maybe 10%, 20%, 15% loss, because you're able to profit from that good basket and offset your losses from those other baskets that aren't performing well. And so that's how diversifying is allowing you to reduce your risk. And if you pick your baskets carefully, if you know that each basket increases in value over time, not only do you reduce your risk by half or by 75%, your returns don't drop that much because all of the baskets go up over time. You're just strategically using these baskets to reduce risk without reducing return. The other thing you could do is hedging. That means exposing yourself to assets that are inversely correlated. Or for day traders, it often means just buying and selling the same instrument at the same time. Now, if you do this, timing becomes more important, especially as a day trader, since this is likely a shorter term move that we're doing. For example, let's just say we have stock X. We buy 1 unit and we sell 1 unit. Now, what you might do is over the next 3 to 6 months, those units that you shorted, they make money. And then at the bottom, you might close those short positions. Or the other thing that you could do is called hedging. And that means exposing yourself to assets that are inversely correlated. So for example, if you have one asset that gains $10, the other one tends to lose $10. And when you do this, it's similar to the diversification thing. If one is losing and one is winning, you can offset that so that you lose nothing. And if you're going to do hedging in the sense that us day traders often do it, which is buying and selling the same instrument at the same time. So you have a short position and a long position, those directly compete with each other, then timing becomes important. For example, you short here, you want to close the short later and then allow the long to make the money. That's a little more advanced, and that's not what this video is about, but it is an option if you're experienced that you can explore. Tip number 5 is don't buy the dip. Now, this is probably the opposite of what a lot of other people are saying right now. They're probably saying everything's on discount. This is the time to buy. This is where millionaires are made. And yes, this is where everything's on discount. Yes, this is where millionaires are made, but no, it might not be the time to buy, because when someone says buy the dip, what's the dip? The dip looks different to everyone. Sure, buying the dip allows you to get in at a better price to make more money. However, like I said, identifying the dip is what is hard. If you zoom out enough, this whole bear market just looks like a dip. So when you're zooming in and you're thinking, I'm buying that dip, I'm buying that dip, I'm buying that dip, you zoom out, there's no dip. You're still at the top of the start of the dip. You haven't bought the dip, you've just bought when the market's going down. That's silly. So the best thing here is just wait. Don't be in such a rush to buy the dip. If the price is $1,000 and you're zooming in, don't buy the dip at 900, it dips again. Don't buy the dip at 800. If we know that stuff are gonna lose value of over 50%, and it's $1,000, don't buy 900, don't buy 800, don't buy 700. Wait, maybe start buying the dips at 600, 500, 400. Now your average buy price is 500 instead of 900. And so you start making money a lot sooner, and you make a lot more money because you were patient. So I guess the tip here isn't don't buy any dips. It's be patient and identify the correct dip to buy. Patience is the important thing here. Nothing kills people faster in day trading than impatient. Ironically, when they're being impatient to make money, it usually ends up in them blowing up their account faster. Being impatient to blow up their account, I guess. So yeah, just be patient, wait, and identify the correct opportunity to go for. Now, moving on to the very last important tip to survive a bear market. This is tip number 6, and that is that cash is a position. No trades is a position. When you're holding cash, that doesn't necessarily mean cash in your pocket. It just means you're not in any trades at the moment. Sure, you don't make money, but you also don't lose. Yes, we have inflation. Yes, that means in a year, you might lose 8 to 10% of your cash's value. That's a hell of a lot better than losing 50 or 60% like everyone else. So if you think that this bear market is too hard to navigate, and you think that there's no way you can stay on top of it, you need to look at the market too much, you're too busy, remember that cash is an option that you could pursue. You're not gonna have any losses other than to inflation, and it's all still gonna be there ready for you to put into the market once we're back into a bull market. Again, it comes down to that patience thing. You don't always have to be in a trade. Sometimes it's best to just go hands off and relax, especially in a very volatile, highly emotional time in the market like now. The worst time to be forcing a trade, if you just want to be in a trade, the worst time is in a bear market because it's extremely volatile, as I said. And when you're forcing trades, you're going to end up having more losses, more panic, more emotion, all the bad stuff we've already talked about. So just remember, it's okay to not be in any positions if that is what you deem the correct thing to do. So that concludes my list of 6 things that you can do to survive a bear market. If you found any of these tips helpful, please go ahead and click the like button, subscribe to the channel for all the future tips that I'm going to be putting out very shortly. Make sure you hit the bell to be notified. Leave a comment on something else you want to see. Maybe share it with a friend if you think they're going to find it valuable as well. And lastly, remember that if you want to work one-on-one with me, get my custom indicator toolkit, as well as my strategy optimization platform, and get one-on-one ongoing mentorship and lessons from me, you can do that. Just go to mie.trade. Links in the description. You know all the other cool stuff. Thanks very much for watching, and I'll see you next week. Bye-bye.